You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to the only show on the internet dedicated to addressing the strategy, growth, and performance challenges facing the leaders of small to middle market food and agribusinesses. This is the Pacesetter Pod, and I'm your host, Joe Mosier. Today, guys, we have a real treat. I'm joined on the pod by Shane Thomas. Many of you are going to be familiar with Shane and his work, but for those of you who don't know who he is, Shane is an agronomist, a marketer, an experienced sales professional, and most importantly, from my perspective, a big thinker. Shane is the founder of the widely distributed and consumed agribusiness newsletter, Upstream Ag Insights. What I love about Upstream Ag as a subscriber is how Shane just weaves together his technical depth of agricultural knowledge and business acumen with a passion for analysis, and what's really great is a knack for storytelling. I always appreciate how he can break down things like a recent funding round, a new product launch, company's release of quarterly financials, or maybe even a merger or acquisition announcement. And he doesn't just get clear on the material facts you need to pay attention to, but he also helps play out the larger lesson or the theme at play. Shane has years under his belt in ag retail, crop input manufacturing, technology startups, and serving as a strategic advisor. And his newsletter distribution covers more than 100 companies and has a readership of over 15,000 people. You guys can tell I'm a big fan. I'm excited to have him on the show. Shane, welcome to the Pacesetter Pod.
Yeah, I'm excited to be here. Thanks so much for having me.
You bet. So Shane, we're going to talk a little bit more about Upstream Ag later on, because I think it's a huge value add for our listeners and for anybody in agribusiness. But for now, I just want to jump right into some of the topics for today. And the first thing I wanted to talk about with you is you spend a lot of time writing about, what decisions leaders of agribusinesses are making in the running their business. And you talk a bit about what you suspect are the inputs and considerations that they have in making those decisions, and the need for them to make trade-offs as they pursue growth. And over the summer, you broke this down in terms of strategy tax and how every decision really levies a tax in the business. Can you walk us through what strategy tax is for listeners that may not be familiar with the concept?
Yeah, I think it's a really compelling concept. And I think, as you alluded to, Joe, every decision has trade-offs and dynamics around it that are suboptimal. You can make the best decision possible, and it might only be 90% perfect or 80% perfect. There's always going to be something contributing to it not being the most perfect decision in and of itself. And I think maybe before talking strategy tax, it's good just to quickly touch on strategy itself. And to me, strategy is really an interrelated decisions that an organization leadership makes to put itself in a position to win. And those decisions come down to, where are we going to play? So what geographies, what areas of the business and the supply chain? How are we going to win in that area that we've chosen to play? What capabilities do we need to have in place? So those sorts of things are really the essence of strategy. I know people think strategy is putting a plan in place, but I tend to subscribe to the Roger Martin view of strategy, who talks about those interrelated decisions and questions that need to be answered to make a strategy and a coherent strategy that's going to put you in a position to win. And I think when it comes to a strategy tax, it's really just the acknowledgement that when you start to make a strategy, there's going to constantly be these trade-offs where if I choose to go after one market, some other market is going to become inaccessible to me. And I have to live with that tax. I have to live with the fact that there's not going to be me successfully going after both markets. And, when it comes to these strategy decisions, you're allocating capital in a specific way, you're bringing skills in-house in a specific way, or developing them in-house in a specific way. And there's always going to be trade-offs to this. And so it's essentially just this dynamic that we need to acknowledge and that we need to be okay with as we progress forward in leveraging that strategy. And as a basic example, before getting into anything ag related, let's just take luxury good companies. So LVMH or Louis Vuitton. they target luxury prices. They target top 1% to top 2%. The people that can spend $5,000 on a handbag or $10,000 on a handbag, they acknowledge that they are doing that thinking that if they execute on creating that aspiration, creating that demand for those high quality products and those high margin products, they're going to be in a better profit position than they're going to be if they were to chase after the $12 handbags that are sold in Walmart, for example. And so they actively choose to not target those cheaper handbags. They target the high end leather stitching, all these special fancy things that come with a story. And so there's a trade-off there, but the trade-off is well worth it, because if you look at Bernard Arnault, he is the kind of orchestrator of LVMH, and he's the richest man in the world currently as of today. And so you look at this and pretty good strategy decision, of course. And so that's the essence of it right there.
Okay. So I said you were a thinker. I didn't realize, you're probably the first person in ag I've talked to that has a strong opinion on luxury goods and Louis Vuitton bags. So the story checks out.
I like fashion, I guess, too.
Yeah, there you go. And for those of you who can't see the video feed here, he's a very fashionable individual, Shane. So if I'm hearing you correctly, though, this is also, so knowing that you make a decision one direction, that then entails a decision that you're not making elsewhere, or a focus or investment you're not making elsewhere. And so it also requires, if I'm hearing you right, a reconciliation with your constraints. Because I think oftentimes leaders, to use this term, to avoid the tax, saying yes to this new thing, we don't go back and say no to anything else that we've been trying to pursue. And so is that part of the framework, as well as recognizing that you have finite resources, finite time, finite people, finite opportunities, and being selective in where you go?
Yeah, I think you nailed it. I think it comes down to that reality that there are the constraints of resources, and there are also constraints in terms of how you're actually positioned in the market. I mean, again, I'm not going to talk too much more about luxury, but again, you can't target a low end a person that wants to spend a low amount of money on a handbag, as well as somebody that wants to spend a lot, because you have these divergent stories and messages in the marketplace, which causes confusion, which causes you not to be able to win going in either direction. And so you have this, I call it like sitting on the fence sort of strategy dynamic, where you've sat on the fence trying to do both things. Your message is confusing. Now, to your point, you also have less resources, you have less ability to actually execute effectively, and you're probably not maximizing not only market share or sales, but also profit margins at the end of the day. And so that's really kind of the core to your point.
Interesting. I think the LVMH example makes a lot of sense. Any examples of whether it's done well or done poorly in the ag context that come to mind?
I'll maybe highlight one that's, I think, pretty prominent today because they just redid their strategy, and then maybe talk about one that's not talked about a lot within the broader ag value chain. But the one that stands out to me currently is Corteva. Their new CEO, Chuck McGrow, came in and basically said, we're exiting, I can't remember, a couple dozen countries. We're exiting the low end of our products in the market so that have a commoditized off-patent product line or segment or active ingredient. And we're going to focus more on differentiated products that we have a patent on that are sustainable according to them, and that are going to be sold in these specific geographies that they've chosen, that they can either command a higher price for that active ingredient, or they have some sort of differentiated strength in that region. And so they've basically foregone these set sales in some of these markets that they've been in for decades. They've pulled out of, whatever it is, a couple dozen countries, pulled out of different active ingredients and different product lines that were assured sales. People were using them, people wanted them, they were in demand, and they said, you know what, we're going to forego that profit, and we're going to reallocate the resources we have internally and the people we have internally to focus in on these new higher margin products. And that's if you look at Corteva's strategy, they've said, hey, you know what, we actually have a lower EBITDA margin, which is kind of one of the KPIs that a lot of these input manufacturing companies look at. They have one of the lowest ones amongst the big four, the Bayer, the BASF, Syngenta, and their goal is really to uplift that for their investors and for their shareholders. And so they've said, here's what we need to do to accomplish that. We're pulling out of these markets, pulling out of these products, and we're going to focus in on this area to try to increase our profit margin and increase our return to shareholders, and hopefully add value to the customer base that we're serving in the interim as well.
That's interesting. What comes to mind there, we talk a lot about the dual mandate of agribusiness leadership and really this kind of tension that exists for executives where you're trying to grow the business and create incremental new value, but also not cannibalizing or destroying or forfeiting your existing business in the process, right? It's this struggle between value creation and value preservation. But when you do that, I mean, the strategy tax is you underperform probably on both sides if you try to do it all. And in this case, in the Corteva example, what seems to be the case is they've said, okay, we understand what the tax is. We're going to control the tax we pay. We're going to forfeit this existing revenue. We're going to exit these markets. That's the cost. In exchange for that cost, we see much more opportunity elsewhere. And that requires a lot of bravery because you're not just giving up the revenue and forfeiting that. You doing that accrues to the competition, right? Those sales don't vanish. Those sales get reallocated in the marketplace.
Yeah.
And so I think it takes a real clarity of strategy and vision where you're trying to go to actually sell that to your shareholders, sell that to the team, sell it to the marketplace, and then get to work.
Yeah, it's a great call out. I think strong leadership in kind of changing strategic direction is one of the core needs. And I think just to build on your point, Joe, is, not only they're foregoing those, but there's also uncertainty in the potential of the products they're focusing on now. I'm sure in their minds, they're confident in the actives, they're confident in the products and the market research they've done, but it takes time, effort, skills in their staff, and to build that up, building up education in the market to actually create demand for not only new products, but new products that cost more on a per acre basis or on a annual basis, whatever it might be. And so they're leaning into the uncertainty. And I think that's what a lot of these organizations that lean into the strategy tax and lean into that uncertainty are the ones that are going to end up in a better place because, it's easy to stick with what what's worked, what's been good in the past. But the thing about markets and the thing about demand and people and farming is nothing is static. Everything's changing, and you're in a position to be able to influence and move that market in a way that you foresee. And you have to have the confidence and you have to have the resources and put the effort in place to be able to execute around that effectively. And, on that, I think I can touch on this now or we can touch on a little later, but I think one area that I'm passionate about is ag retail. And, I'm pretty into the fact that there's a ton of technology out there. I think retail sit at this really interesting intersection around, there's fertilizer, there's crop protection, there's biologicals, there's precision services, there's a lot, and they can be the group that executes on all of those. But at the end of the day, human beings and organizations themselves only have so much capacity to deliver a high-end service or understand all these different products. And one of the things that you hear a lot about in the ag retail space is, it's hard to make money on herbicides, or it's hard to make money on fungicides, margins declining and all that. And, I think today the average retail would say we need to sell herbicides. We need to sell pre-applied, post-emergent. We need to sell fungicides. And I think there's probably some dynamic around that because those are more default products. Farmers use them, et cetera. They use urea, these commoditized fertilizers. But if I'm a retail today, I'm looking at all these new segments that have incremental margin opportunity, incremental opportunity to differentiate yourself. I might be sitting there thinking, hey, what happens if I actually stop selling herbicides, fungicides, insecticides, maybe even in their entirety, and we reallocate our staff's time, training, and our efforts into specialty fertilizer, biologicals, precision ag services, seed treatment, these sorts of things. All of a sudden, you have a very differentiated margin structure. You've now invested in your staff in a unique way, and it might be more enticing to a certain type of individual that's bored selling a herbicide. As much as, full disclosure, the reason I got into agriculture was actually I really liked herbicides, but there's a lot of new and interesting things. And so all of a sudden, if I'm in ag retail, a lot of them are stuck thinking around what's our market share in herbicides? What's our market share in fertilizer? But if you flip that and say, our North Star is actually, we want to get the best return on invested capital, that actually might look very different in terms of the products you prioritize, the ways in which you sell them, the business models in which you try to go to market with. And so the tax in this instance, to bring this back to what we were talking about, is you're not going to sell maybe you're a small, medium-sized retail selling 100 million a year, maybe 40 million of that is herbicides. You might slough all that off, but that was only 2% margin anyways. But now all of a sudden you can grow these specialty products that you have 30% margins on, or even bigger, or even sell something that's never been sold before, like some sort of new precision ag service. And all of a sudden you have higher margins, you have differentiated conversations with your customers, and you're not trying to compete in the so-called red ocean. It's this blue ocean opportunity that is unique and novel to you. And so there's a tax to that, but there's also this upside that is there to differentiate yourself.
Yeah, really, really good example, Shane. And I think if I try to synthesize this in terms of the lesson or the takeaway for some of the listeners here is one, of course, recognizing that there is a tax associated with these decisions that you make. Two, that the tax brings into stark focus the real constraints that exist within your business, whether you want to believe it or not. You can't do everything all the time. And then just, frankly, just facing the discomfort of, if you do a traditional cost benefit analysis, the costs are known. Here's the sales that we're giving up. Here's the margin we're foregoing. Here's the market share we're going to give to the competition. And then the benefit is a little bit more of a intellectual exercise because outcomes are uncertain. But if you look at a market and you think there's just asymmetric upside here, no one's doing it as well as we think we can do it. No one's talking about the problem that we think we can solve. No one's bringing a solution to market that's going to meet a unique need of our segment. If that opportunity exists, then it's frankly just getting comfortable with the discomfort and then pulling the trigger. It's interesting you use Corteva as an example because large incumbents generally have a harder time in terms of innovation and new market entry and kind of being as agile as what you just kind of laid out. And I'm guessing that the majority of listeners are familiar, either have read or are familiar with the book, The Innovator's Dilemma, and the notion that large established companies that they lead their segments, they own the place that they play, they have strong brand recognition, they've got proven performance. All of that benefit that seems to accrue to them over time becomes a liability because it makes them reluctant and slow sometimes to enter a new marketplace simply because doing something different can cannibalize their own revenue and margins. A lot of things you just talked about. And in the ag context, I think this is highly relevant given just the large fixed investments that are required to build and operate and maintain all the physical infrastructure and equipment, both mobile and fixed, that the businesses rely on. And so sometimes I think the innovator's dilemmas would be better named the incumbent's dilemma. That's my own my own thought. But this dilemma weighs more heavily on those that have something to lose. So outside of the Corteva example, which maybe bucks the trend of what I would have imagined, what are you observing in both traditional ag supply chain and ag tech and how this is playing out? I mean, how good are the incumbents doing at going into new spaces and being agile?
Yeah, it's a good question. And I would say it's, I'll go in one direction and I'll maybe bring it back in another. And I think one example remains to be seen is on the Bayer front, where similar to Corteva in a lot of ways, obviously a seed and chem manufacturer, crop protection manufacturer, they've now, I'll call it, doubled down and really are leaning into regenerative agriculture, trying to create new revenue sources for themselves, whether it's in the carbon space, whether it's in biologicals, those sorts of areas. They're trying to create new services that can benefit their customers as well as their business. And I think that's an area that they're working on, and I guess we'll see how that goes. But I think to tie that into some of your comments, which I love your way of framing it on the incumbent's dilemma. I'm not familiar with that term, but I really like it. So I think it nails it. And with Bayer, their new CEO, who's the CEO of the overall entity that includes like the animal and pharma side of things, as well as the crop protection and seed. But this individual has stated, we're going to be a sole proprietorship. We're going to react in this really quick, agile way. And I think it's great to say that, and maybe they will do it. But I think when it comes to lots of these large organizations, like you alluded to, they have something to lose. They have market share, they have profit margins, they have shareholders they're beholden to. They have all these different things that are keeping them from shifting in any sort of crazy way, because the markets and shareholders tend to like stability and consistency and like seeing where things are headed. And when you change, to your point, there's uncertainty there. And so I think with them, there's a lot that they need to change when it comes to their staff and their culture. Because if I'm at Bayer today, I know that if I make a decision that is risky or that is maybe not totally agreed upon, it's maybe a little more contrarian, all of a sudden I'm at risk of not only missing my numbers and missing out on my bonus, but now what are my career prospects like? And so you have this large entity that's kind of coalesced around these iterative growth dynamics versus anything really unique and risk taking like. And so unless they start to incentivize these individuals to make decisions like that, or maybe better stated as not penalize is probably the biggest way, and actually celebrate if there is a failure in some ways. And I think that's one way that you'll start to see some of those organizations like a Bayer hopefully try to navigate these complex changes in the market and these things that are going on. And the difference there is, and I'm kind of getting away from your question, but I think it's interesting in the sense of you have startups, for example, where everybody talks about how innovative they are and how agile they are and nimble and all these different things. And the reason for that is they have nothing to lose. They are, you have a lot of people that are at these organizations that they have lesser salaries than what they would at a big, large company. If they don't make the sale today, they might not have a paycheck tomorrow. And so you have these constraints that really drive individuals to take risks that are calculated. They're not relying on a brand to make some of these decisions or these meetings as well. If I have Bayer behind my name, a lot of doors just open. Whereas if you have John and Jane Doe Egg Tech startup, you have to do a lot of work to try to actually get something to happen. So you're constantly you have this bias for action. You have this bias to try to build up relationships. And so we'll see, maybe to bring this back, I think Bayer's an interesting one where they're kind of iterating and they're trying to go in a slightly different direction, acknowledging that when it comes to crop protection, they might need to be a little more innovative in figuring out how to manage that revenue stream in the future. But if we go to an example of an incumbent that I would say is doing a pretty good job, you can look at John Deere, for example, where they have they've kind of built this into their, I would say, culture of we have innovation there. We prioritize technology. I know my friend Jeanette Barnard just talked about this in one of her newsletters, where if you go look at the John Deere executive team, they celebrate and talk about the technology experience they have, and they have focused on building that skill set or that muscle out, so to speak, and they've positioned themselves to be able to take advantage of these new technologies that are coming to the market, and they've acquired some of them, and they've worked at implementing them as part of their core competency. So I'll use Blue River technology and their See and Spray precision spraying capability. They've worked on integrating that directly into their spraying units or tractors or pieces of equipment. And they've done so in a way that is slow in the sense that they're not going to market with thousands of them trying to spray them across the landscape, but they're trying to learn, they're trying to understand them, and they're incentivizing their team in a way to really drive success and understand these products in a way that can make them successful long-term, because they see those trends and they see these needs coming forward. And so those are maybe two areas, not that Bayer's doing bad necessarily. Again, they're early on in some of these initiatives, but John Deere, I think, you look at their numbers, even in terms of their operating margins and these sorts of things and their growth and share, they're growing and they've been successful. And it's not entirely because of their innovative culture, but you can imagine that it's probably a good chunk of it.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
Yeah, thank you for those examples. I always struggle with this because I sometimes question the merits of incumbents trying to act like startups. It just feels like it's a bridge too far at times. And in full disclosure, I spent many years at Cargill, and we spent a fair bit of time especially towards the end of my tenure there, talking about, big boat, small boat. And, the modern wars are probably not going to be fought on with aircraft carriers, be with smaller vessels, et cetera. And I hate to use military sort of analogies, but, in the Second World War, it was all B-2 bombers, high altitude, hard to hit from the ground, maybe inaccurate. And then over time, it became more deploying or scrambling fighter jets. And now it's drone swarms, right?
Yeah.
That's how engagements are fought. And so, yeah, sometimes I just struggle. Is it actually right for the big companies to act like startups? Is it even possible for them to do that? But I think you're providing some pretty interesting examples where maybe they can, whether it's a carve out and a group within the organization that's provided that runway to say, we're going to celebrate failure and we can demonstrate that that's true. It's not going to cost you your career to make a fast, wrong decision.
Yeah.
We want you to take non-consensus bets.
Yeah.
And try new things. And so I guess the opportunity is there.
Well, I think, one thing I would say on that is I think that large companies can operate in innovative ways. I don't truly think they can operate like startups. I think my kind of advice or my view is that if you hear a senior executive at a large entity saying we operate like a startup, I would run the other way, because to me, that just shows they don't actually understand what makes startups. It's, it's the constraints, and you can't replicate the feeling of not knowing if the company you work for is going to be around tomorrow, not knowing if you're going to send 200 cold call emails out or make 200 cold calls and get a response. You can't replicate the dynamic of having no HR to go through all these different dynamics. There's just so much that goes into these large companies that I just truly don't think it's possible to operate like a startup. There's, again, ways to operate more innovatively, but my general view is why not operate to your strengths? And your strengths are probably in that you do have a large access to the market. You do have a lot of market share. And so find ways to leverage that in a unique way. And that doesn't mean that you can't acquire startups, have them come in interesting ways and that sort of thing. But I think too often there's this view that you can be a startup, and I don't think it's possible. I'd love to be shown that's wrong and someone give me examples of it. But on average, I think you have way too much bureaucracy and all these things that come with a large company to really operate in a startup fashion. But again, that doesn't mean you can't be innovative. It just means that it's a different way of being innovative, and you're leveraging different tools, different resources, access to different people, all these different things.
Yeah. And I think we're starting to see a trend towards just the large incumbents, maybe not taking majority ownership positions, but taking significant equity positions in startups as a way to get access to new and emerging technologies, new and emerging products, to keep a presence in that market, but maybe doing so in a way that's actually carved out and outside the four walls of their day-to-day organization. So kind of building on that, you have a passion for ag tech. That's my statement. Maybe I'm wrong, but you follow the space very closely. You write about it a lot. And what I'm not going to ask you is for your general survey thoughts in the state of ag tech today. That would probably be interesting, but I wonder if you can maybe provide a little bit more color on why the ag tech space has been such an attractive destination for capital, really over the last decade or so. I mean, I think people have really commented on the froth over the last 3 to 5 years, but it's been a decade or even a little bit longer journey as ag tech has really ramped up. And so what are your thoughts there on how this emerged so suddenly and so significantly within the market?
Yeah, I think there's probably a lot of answers to it. I'll maybe zero in on 3 that stand out to kind of be the disproportionate influencers. And I think, one of them is this perception that farming and agriculture is the least digitized or one of the least digitized industries. And so you have a bunch of people saying, hey, let's go digitize the industry. And so that's what drove, especially if you go back to that 2013 to 2019 kind of time frame, there was a lot of money coming in to fund farm management softwares and these sorts of things. And so that perception of lack of digitization is one thing that drove it. I think a second one would be this whole notion of feeding the world and being able to support everybody. The saying is everybody's got to eat. We got to feed 9 billion by X year. And so I think a lot of that has really driven the interest in the space, because ag is really, I think people talk about ag tech like it's new and it is only a decade old, but really the technology's been constantly coming in. If we go into hybridization, if we go into genetic modification, if we even go into engineering from an equipment perspective, like technology has really influenced agriculture for literally thousands of years. And if we think of technology even as simple as what a tool is, because when a new sheath to swath wheat or something, technically that was technology at one point. And so I think technology has definitely influenced the industry for a long time, and it will continue to influence the industry. And so this whole feeding the world aspect and needing to grow more and higher quality, and I think that's another aspect. And then, one that's probably driven, I would say, at least the last 3 to 5 years for sure, is the environmental aspect and being more environmentally friendly, being a part of the carbon solution, carbon sequestration. And so there's been a lot of that. And so those I think are kind of three big ones. But, plain and simple, agriculture does have problems as well, too, in the sense that labor issues are real. It's not like they're imagined. There are labor issues. And so there's a lot of money going into autonomy and robotics and these sorts of things. There's cost of production challenges. You have, we talked a little bit about precision spray, where you're spraying a field, 100% of that field or every acre getting sprayed when you only need to spray 20%. Well, is there an opportunity there to decrease that for farmers? And so, those three are really the big macro drivers, but there are really challenges that need to be overcome and can be solved. And investing in the space and startups is one of the key ways to overcome that and help support farmers moving forward.
Where are the green shoots right now? I mean, obviously the entire tech space, that whole tech umbrella, whether it's ag or generative AI, crypto, SaaS, take your sub-segment or your sub-vertical there. It's all under pressure. But from an ag tech perspective, where are the green shoots? I mean, where are we really starting to see traction of solving real problems with real provable solutions that have real value?
And I think, some of them are still not. If you go look at some of the companies that have been funded over the last decade, there's not a lot of those that are influencing, say, hundreds of millions of acres. Like, for example, if you take herbicide tolerant traits, those were literally one of the fastest adopted technologies in the world ever. Putting that up against any technology out there, they were influencing hundreds of millions of acres within a decade. And so that was really, really fast. Whereas this more digitized technology, software, AI, robotics is a little bit slower in that regard. But I think one area that I tend to look a lot at is maybe not so much on the farmer end, but it still impacts farmers, of course, which is really this kind of digital infrastructure and software for the service providers that support farmers. And so this is the ag retailers, this is the input manufacturers, this is the grain origination facilities. I look at some of those companies like the Ag Vens of the world, the Bushels of the world, the Smart Wires of the world. You have this almost talk about the digitization aspect earlier. This is that opportunity to help digitize the workflow, the customer experience, CRMization almost of agriculture as well. So that's an area that I would say is getting a lot of traction, in the sense that if you look at utilization of the Bushel app or the AgVend app, they have 50, 60, 70,000 downloads from a farmer perspective and are used every single day by agribusiness professionals that influence millions of acres. And so that's one area that I see a lot of not only traction, but actual influence and driving of support for farmers and the industry. Another one that's on a smaller scale, but kind of alluded to already, and I think will grow, is the precision spraying. So you have John Deere they had their own internal capabilities, but also acquired Blue River. You have Green Eye Technologies. You have Bilberry that was acquired by Trimble, that now recently just got acquired by AGCO. Have Augmenta was acquired by CNHI. And so these are technologies, and this is an area that I think there's still some challenges for them to overcome when it comes to pricing models, when it comes to getting the confidence and the trust in the farmer built up. But it's pretty undeniable that there's a lot of value that can be unlocked for farmers with those technologies to spray only 15 or 25% of a field and not spray every single acre with a product that doesn't need to be there necessarily, as well as capturing more data to inform better decisions moving forward. And then maybe one more is automation and robotics. This is another smaller area, and specifically in the call it area of agriculture that I think a lot about, which is the large scale row crop farming in North America. But I look at Salimtech. They're a fascinating company that's, I would say, reimagining how farmers go about alleviating abiotic or biotic stresses in their field, go about managing and monitoring their fields. And so they have this small autonomous robot that they say is, supposed to live in the field. And they've continued to get traction and interest in Brazil, where they started, in Canada, in the US. And so they're an interesting group, but again, kind of built off that automation and robotics dynamic where labor is a challenge, data acquisition is a challenge, and kind of this disconnected flow of data inflow and capturing and the utilization of that. And they are kind of sitting at that intersection there with their view on how that Solix robot lives in the field. And so those are three that tend to stand out to me today.
That's really helpful and informative. I don't spend anywhere near the amount of time thinking about this that you do, and perhaps nobody does. But it also feels like the sector writ large, or the investment community, the innovative community, they're getting better at actually trying to work from a problem back, as opposed to work from a technology and product forward, which just is generally a successful formula to work from the problem back. Somewhat related, but I guess maybe shifting gears a little bit, is you recently did a breakdown analysis of the latest capital raise by Indigo Ag.
Yep.
Which is maybe not quite the scrappy startup that we've talked about with some of the other firms you just mentioned a couple minutes ago, but it still is a non-traditional player in the space. And this latest round was actually a down round. So they saw a significant drop in their valuation. And, for anybody who hasn't read that, I'd encourage you to, we'll talk about Upstream here in a couple minutes, but go check out that analysis. It's really interesting. It's a perfect example of telling a story with larger lessons, just with the filter of one particular company. But in the context of Indigo Ag, their down round, their revaluation, what are the lessons that can be learned about this idea of solving the right problems and being focused and maybe paying that strategy tax up front to the benefit of your customers, to the benefit of your investors and your employees? What are the lessons you'd glean from that?
Yeah, I think there's probably a lot. And I know, probably the first one that is maybe not specific to Indigo, but I think they're an example. And full disclosure, when it comes to Indigo, they could still very well be successful. It looks unlikely when I look at it and analyze it through the lens of the information I think they have a lot of hurdles still to overcome, but I have nothing against Indigo, and I do hope they become very successful. But I think it's interesting to look at the challenges that they've ran into. And I think one of the first ones that they ran into, and there's others that have done this as well, it's not purely Indigo, but organizations come into the industry and say, we're going to disrupt the industry, which that's not how disruption happens. Disruption happens through identifying a problem that can be solved in a more, call it, elegant way or a novel way that is better for the customer. And ultimately, disruption is all about the customer. I mean, if the customer prefers your solution over the other solution, that's where disruption comes from. And I think we get so caught up in disruption and disrupting this, and it's AI and it's all that. And I think disruption is about customers and it's about solving their problems. And if you solve their problem better than the traditional way today, that's technically disruption. And I think that gets missed. And so I think, starting with a very focused, specific value proposition was something that Indigo kind of tried to do, but they then really got spread thin really, really fast going into, the kind of story is they were 7 or 5 startups in one or something like that. And I think what drove that is actually another portion of what we can learn from Indigo is that you need to be focused. But then what happens in agriculture is it's all not only very interconnected, clear across the entire value chain, but it also relies heavily on physical infrastructure. And when you don't have the physical infrastructure, whether that's for accepting grain delivery, storing grain, trucking grain, railing grain, it's very, very hard to disrupt because there's really consolidated incumbents kind of at every different point that have a ton of capital invested in that infrastructure, whether it's the Cargills and the Bungies and the ADMs of the world at the grain origination and processing world, or it's the input manufacturers that are at the R&D side of things, or the retails where the likes of Nutrien and Helena make up a significant portion, upwards of kind of that top 3-4 retails makes up almost 50% of the North American retail. And so you have really oligopolistic dynamics that are really tough to disrupt, because no large company says, oh yeah, just come in and disrupt us. And no farmer wants to sit there and have delays or have uncertainty around when they can sell grain, how they can sell grain, when they're going to get their product, because they're time constrained. And so the physical infrastructure dynamic is one that Indigo found out and then started to try to acquire companies or try to build out different capabilities that just were never going to make sense without immense capital deployment. And so that's another one. I think another thing that comes in is even just the reality of relationships and regionalized dynamics, where relationships are important, and you don't really build relationships by being a large North American wide entity to start. Most companies start small and build out. Specifically in agriculture, they do a really good job in one area, expand, do another good job there, maybe they acquire and build on. But you don't start being this macro business, because agriculture is very relationship driven, but it's also very regionally nuanced, not just in the cultural, but the practice dynamics, the crops grown, all these different things. And so Indigo, trying to be in all parts of the US, doing a bunch of different things, really, I think, challenged them being successful there. And you're also in a commodity business where there's razor thin margins. It's not as if you have software like gross margins like we see out of Silicon Valley, which are 70, 80%. You're talking about really, really thin margins on whether it's a, I'm going to Canadianize this probably, but say like a $500 per ton, you're maybe making $20 per metric ton off of that. And so you're very razor thin. So there's not a lot of room for error. There's not a lot of room to play with to reinvest back into the business. And so that's where a lot of these challenges really came in for the likes of Indigo, but they told a really good story around it, because all of a sudden you can say the total addressable market is X number of trillions of dollars, because we're going to touch from the microbials and the seed side of the world all the way downstream to the CPG and food companies, and we're going to capture dollars everywhere in between. And it's just really, really hard to execute on. And so there's a lot in there, but I think there was a lot that became, to some, to their credit, probably acknowledged that and knew that as soon as Indigo was coming into the market. But I think a lot of the people that are slower learners like myself figured it out along the way. And so best of luck to them as they do continue to try to progress, though.
Yeah. And yeah, to be clear, I mean, a down round is not an obituary, right? Companies, it's disappointing. It's a hard sell to your previous round investors. It's a hard sell to employees who have options that suddenly have maybe evaporated in terms of worth, or they're underwater, or maybe the glide path to a attractive exit is different. But I think to some degree, to kind of build off a couple of things you said there, Shane, I think this just this compelling and sort of magnetic idea around disintermediating the ag value chain. And I think it's because, and this is maybe true everywhere, if you don't understand the space, there's this presumption that a middleman is just eating margin without any sort of a corresponding benefit. So to say, okay, well, the farmer, they're basically, they're selling spot, maybe they're selling some forward contracts, but it all goes to that elevator, and that elevator is the middleman, captures margin. And then it goes to the terminal to be put on rail or river and eventually hits an export or a consumption market. Or if you're a seed business and you're selling through dealers, right, and the dealers are taking a margin, just this idea of, if we can disintermediate, if we can remove the middleman, there's real value to unlock there. And in some cases, there absolutely is. But I think to your point of the regionalized ag value chains, relationship-based nature of the business, and the fact that, I mean, and just thinking in terms of very simple grain origination and distribution, those country elevators provide a real valuable service to farmers who don't have the on-farm storage, don't have the ventilation and climate control, don't have dryers, don't have the infrastructure to load in the middle of February, depending on their latitude. There's a real need. Those elevators help them manage their future price risk, help market their grain, and help them, provides a destination to get it off the field when they need to get off the field. And so I think as more entrants come into the space, if they have a healthy appreciation for why the middleman exists, then maybe the real opportunities will emerge. I learned early in my career, you don't take down a fence until you know why it was built, because you want to be pretty sure, are you keeping something in or keeping something out? And I think that just speaks to the need to really understand the space.
Yeah, that's a great point.
So Shane, as we kind of come to the end here today, I do want to spend a few minutes talking about Upstream Ag.
Sure.
Your labor of love. So Upstream Ag Insights, what is it? Why do you do it? How can people access it, learn more?
Yeah.
What can you share there?
Yeah, for sure. And so essentially what Upstream Ag is it delivers essential news and analysis to agribusiness leaders every Sunday morning. And I'll get into, what that specifically entails. But I think the kind of crux of it is, why is it around? Why do people read it? And I think if you go look at most industries, whether it's the real estate industry, the railway industry, finance, technology industries, or even in agriculture where you have fertilizer commentary and grain commentary, there's somewhere to go for analysis of what's happening, why it's happening, what it could mean, trying to inform individuals. There's a place for them to go and understand that. In agribusiness, when it comes to the inputs and the equipment side of the world and the technology space particularly, there's not been anywhere to go and find this jumping off point, or these ways to think about the problem or what just happened or what transpired that week. And, I think often about myself being I'm Canadian and worked in ag retail in 2017 when FBN was coming into the Canadian market. And I didn't have a good or a bad view of FBN at the time. I didn't know much about them. They were coming into the Canadian industry, and everybody in the industry was like, oh, they're going to try to sell farmers data. They're bad for farmers. They're bad for the industry. Everybody that was in the mainstream industry had that kind of roughly in their head. Media, they're not incentivized to traditional ag media. Much, it's not a knock on them. They get their advertising dollars from the big input manufacturers, equipment manufacturers. They're not incentivized to give you, and nor is it their job necessarily to provide frameworks or ways to think about these new companies that are coming in. And so I had nowhere to go personally to find out what could FBN coming into Canada mean for me? What could it mean for my team? What could it mean for the business as a whole? And so that's really the kind of hole that I think Upstream tries to fill, is really try to give a jumping off point for agribusiness leaders to understand the dynamics going on within the upstream portion of the industry. And so I want to be able to help them deliver frameworks and thinking tools for leaders to be able to better understand and assess how news, events, earnings reports, technology, how that might impact them, their team, and their business, just like I was thinking there in 2017. And so that's really the crux of it. And it's not too hard to find. You can go to www.upstream.ag, and that's where you can subscribe for free. Or if you want to get the incremental insights and analysis and frameworks and images and tools, that you can become an Upstream Ag professional member and subscribe that way.
Fantastic. Well, I'd encourage everyone, if you're not familiar with it, just follow those breadcrumbs, check it out. I doubt you walk away saying that was a waste of time, and you likely walk away saying, I wish I had this a lot sooner. That has been my experience. Shane, tremendous gift to have you join me today. So I just want to say thank you. I'm a big fan and supporter of you and your work, and I want to thank you for applying your art to the benefit of agribusiness in general. I thoroughly enjoyed the conversation today and would love to have you back sometime, because there's going to be no lack of things to discuss, I'm sure.
No, and I appreciate the opportunity to come join you. I'm a relatively new listener to your podcast, but I've really enjoyed it, and I've really enjoyed, much like how Upstream, there wasn't a lot of places to go for what I just alluded to. When I look at the podcast area of agriculture, a lot of it is focusing in on companies, or it's focusing in on commodities or something like that. But when it comes to what's going on from a strategic dynamic, I love what you're doing, and I've become a big fan and listener every week. So thanks for having me on, and looking forward to listening to more in the future.
Fantastic. Thanks, Shane. And thank you, as always, to all of our listeners for tuning in today. Please remember to like and subscribe to the Pacesetter Pod wherever you find your podcasts, and we would love it if you would leave a review. This greatly improves our ability to get in front of the right people in our industry and try to offer something of value. So that's our mission here. That's our goal. And if you can leave a review, let us know what you think, how we can improve, but also help get the word out. That'd be much appreciated. You can also find and follow me, Joe Mosier, on LinkedIn. And if you want to explore how we can help your agribusiness better execute strategy or M&A, you can set up a call with me directly from our website at www.mosiercg.com. Thank you for listening. Keep getting after the growth of your business, and have a safe day.
This is thepodcastfactory.com.